With that, we'll make a start.
Thanks, Jeremy. We're putting together the slides and kind of trying to figure out how to start something like this. And I imagine you're all pretty familiar with continuous disclosure, but if you do me the privilege of just giving you a bit of a primer as to what we're really talking about here, because I think it is helpful when we get into the detail and the nuance of when to disclose and when not to disclose. So, I mean, at its heart, continuous disclosure juxtaposes with periodic disclosure. So periodic disclosure being kind of annual and half-year reports, and for those on ASX that are required to, quarterly reports. And then the continuous disclosure regime sits over the top of that and says, in essence, anything that a reasonable person would expect to have a material effect on the price or value of securities needs to be disclosed immediately, unless an exemption applies, and we'll get through what the exemptions are. And so we thought we'd jump straight into an example, which, and hopefully there's no one from Nuix here, or if they are, hopefully what we're about to say is consistent with their views on how this all played out. But Nuix IPO'd in December last year. First result was their half years, which they put out. They announced in February, and it may be a bit small for you to see on the screen, but when you read their announcement that they put out on the 26th of Feb, you kind of think, well, it doesn't look too bad. They reaffirmed their prospectus forecast. They said their half-year revenue was down 4%, but it was in line with their forecast guidance. You kind of look at that and you say to yourself, well, that all sounds reasonable. Wonder what the market reaction is going to be. If we jump to the next slide, we'll show you what the market reaction was, which was not very positive. So the stock traded down 32% that day. And that must immediately throw up questions in your mind as to why is it down so much? What was in that result that led to that downgrade? The reporting after the fact suggests the market was expecting earnings to be a lot higher, and that the market is concerned that Nuix will no longer be able to meet its forecast. Jeremy's comment earlier around the distinction between kind of front-end analysis and back-end analysis, and what we mean by that, I guess, is front end, when you're trying to decide whether to disclose or what to disclose, and in essence, that often boils down to whether information is materially price sensitive, whether the market is going to react to your information. I mean, ideally, you have a perfectly informed market, and when you put out your results, they yawn at it, whether it's fantastic or terrible, because they already knew in advance where it was going to come out. The fact that then you think about the back end, where you've got the benefit of hindsight, and you look at this and the price is off 32%, it's almost definitive that that information was price sensitive, that the market didn't know it was coming and has been surprised by it. So then the question becomes, well, what should they have disclosed and when should they have disclosed it? Because you can't necessarily wait till your results are signed off by your accountants and they're ready and packaged up and approved by the board and ready for release, because that's not what that's periodic disclosure, not continuous disclosure. The continuous disclosure regime looks at immediate disclosure once you're aware and once you know. And so we'll get into this more as we go through it, but the real question becomes, well, at what point did Nuix, and by that we kind of mean the directors and officers, what point did they know the information, the relevant information here? And it's not even really clear to us as outsiders what that information was that was materially price sensitive, but you can I think safely assume it was the headline revenue and earnings numbers. At what point did they know those numbers were going to be what they were, which was such a surprise to the market? And it's hard to say when that was, but it's unlikely that it was the 26th of February. Generally, management and the board will have an idea of where results are going to come out well before they come out. And it may be that they were working through it right up until the 26th, in which case that was the moment that they were aware when they announced it. And if that's the case, then you look at continuous disclosure and say, well, they have no case to answer. There can always be surprise events. Businesses are inherently risky. But the question for legal practitioners and directors and officers is to always be thinking about when do you need to disclose and can you afford to wait. Maybe we'll jump into it now and go through some of the detail of what the test is and some of the more abstract kind of rules.
Yeah, thanks, Scott. And I think that, on the Nuix example, I think why that's a good one to sort of start off with is that it's also deals with one of the topical issues around earnings guidance and earnings surprises, and assessing a company having to assess what they're providing to the market relative to what perhaps sell-side analysts may be expecting how the company to perform. So notwithstanding the company may not have given forecasts, it's still got an obligation to consider what the market has priced into the shares in order to determine whether there's a continuous disclosure obligation. So as Scott touched on, there's a few critical components to what makes up a continuous disclosure obligation. This is all under Listing Rule 3.1, which you may be very familiar with, and it's really one of the most critical listing rules, and in some respects, one of the most difficult ones to apply, given whilst the test is fairly short, the application of it can be very complicated and nuanced. So the first element is whether or not is around when an entity becomes aware of information, which I'll touch on in a minute. The second part is whether or not there's a reasonable person expects that information to be disclosed, and whether they would expect it to have a material effect on the price or value of securities. And if those tests are satisfied, then the company has to immediately disclose that information. Now, immediately in the circumstances really just means promptly and without delay. So it wouldn't be good enough, for example, for a company to become aware of it at management level, pass it through to the board to become aware of it, but wait to announce something until they've held a meeting 24 or 48 hours later in order to formally approve something. That's not promptly and without delay. There can be circumstances where the company has an immediate obligation to announce to the market, notwithstanding there may not have been formal board approval. Jeremy, I might get you to flick to the next slide. So awareness is actually a really is a really interesting one. This goes to who within the organisation has become aware of the information. Broadly speaking, that's both directors and executive officers, so CEOs, CFOs, executive management as well. And what's critical here is that it's also whether or not those people ought to have known or reasonably ought to have known of that information. And what that ties into is it is critical that a company have appropriate reporting functions in place. So there have been circumstances where companies have argued that that directors may not have been aware of information, but because part of that has been as a result of, for example, insufficient reporting procedures to make sure that material information flows through. So there can still be scenarios where even if the board isn't aware of that information, that there's a continuous disclosure obligation. And really this comes back to also sort of the contravention, or the, who's involved in that contravention. So it's the key point here is to note that it's broader than just the board.
I mean, the other thing I think is interesting to note here, Jason, is the way this test works in terms of what is it that you have to be aware of. And the test relates to the materially price sensitive information. It's not the fact that that information is materially price sensitive, which is often part of the challenge. So there are some things where it's obvious, I don't know, a disaster, kind of major litigation, signing a new contract, where you know exactly what the information is. But other times, like in that Nuix example, it'll be your results. And you may know what the results are going to be, but you haven't yet formed a view as to whether that's materially price sensitive, because that requires a degree of understanding or assessment or sounding of what the market expectation is. And so the rule doesn't allow you to know the information and then take the time days, weeks to collectively agree as a board or as a management team whether you think that that information is materially price sensitive. The trigger basically starts from when you become aware of the information.
Yeah, and I think that's right, Scott. And I think it also ties into sort of the immediacy of when that information needs to be made. So as you say, if it's a material piece of litigation, if it's entry into a contract, it's pretty clear as to when somebody becomes aware of it, and therefore, and also when that disclosure requirement kicks in. Where it's a more complicated fact scenario, and take earnings, for example, you may be needing to pull together information from different segments, different business units. They may be in Australia and overseas. It can become a lot more difficult to analyse when, you know, in part or in the aggregate, those pieces of information actually become material, and therefore when you've got that immediate disclosure obligation.
So I think that's a really good segue into this next piece, which is, what do we actually mean by material? So we've worked out now what we're talking about in terms of the information, and we've also talked about when we become aware of it. But what are we actually benchmarking it against? What would that reasonable person expect to have the material effect on price? And so really, the way in which ASX provides guidance here is to say that there's a general test, although of course, like everything, it's very nuanced and it's not definitive, and so it always depends. And that's why, you know, it keeps people like us busy, because it always depends, and you do need to apply it to each fact circumstance. But at a general level, what is considered materially price sensitive is where the information is going to move earnings or price by 10% or more. So the general rule is, if it's less than 5%, the starting position is it's probably not material for this purpose. If it's 10% or more, the starting position is it probably is material. And then there's obviously the very large grey area between the two. And so that's really the way in which you need to think about this when you're looking at these issues. After you've worked out that you've got the information, you need to think about what it is and how we're benchmarking it. And at the end of the day, because there's this 2020 hindsight test that we talked about before, you really need to ask yourself, if you're in that situation, would I trade at the moment based on the information that I know? If I'm an insider and I'm aware of this information, a really good litmus test to determine whether or not it's probably material or not is, would I trade on this information now? And if I did so, would I be comfortable, or would I feel like I might be exposed from an insider trading perspective, because the market wasn't aware of this information, and had they been aware of this information, it would have impacted their decision. If it was going to impact their decision, then you probably need to start thinking about whether that information is actually material, and therefore whether it warrants disclosure. But as I said, that general test is around that 5 to 10% point, and we'll touch on some of the nuances there as well, because of course not all companies are the same, and so if I just jump to that, 10% for one company and 10% for another could be very different, and that's important. So last year, what happened was ASIC actually provided some updates, and that was because of a decision that was made around Myer, which we can talk to later on. But essentially what they said was that where your percentage movement departs, if you are a large company, ASX 300, or otherwise have really stable earnings, then a smaller movement is likely to surprise the market more. Whereas if you are a either a smaller company or a growth company or a company that's got variable earnings, then it probably is going to take more of a movement for the market to be surprised. And so the general guide that they gave was 5% or something closer to 5% is probably going to warrant disclosure or careful consideration of disclosure if you've got stable earnings. So, for example, a toll road operator is a good example. If you're a toll road operator and your earnings shift by 5%, that's likely to be material. But if you're a growth company like in the e-commerce space at the moment, or in the buy now, pay later space, and your earnings grow by 5%, I suspect that's not going to be considered material, or may not be considered material. And so that's the context in which a little bit more guidance is provided. But of course, again, it's just guidance, and it still just depends. And you still do need to turn your mind back to, would you feel exposed if you traded on this information and that information wasn't in the public domain at the time? So what is the 10% or the 5% based on? What are we actually starting from? What does the market expect? Because at the end of the day, continuous disclosure and share price movement is all about market expectations. So what is the baseline? Well, the baseline is, what have you told the market to start with? So for companies that publish guidance and tell the market what it is likely to achieve in a particular period, then that is what the market expects, because that's what you told them, unless what you're telling them is just way off the mark and no reasonable person would expect it, which can happen in rare cases. But for most companies where they provide guidance, that's therefore what the market expects. And so a 5 to 10% movement from what they expect is going to move the share price to the point where it's considered material. A lot of companies don't publish guidance, and particularly in the last 12 months, most companies chose to withdraw their guidance because of the challenges around COVID and their inability to predict what was going to be over the last 12 months. And so we saw about 12 months ago and through March, April, May of last year, we were spending a lot of time working with clients on how to manage this aspect of their disclosure obligations around earnings, and in many cases, how to go about withdrawing guidance, because it just wasn't reasonable anymore for them to have guidance out in the market at all, because it was going to be no more than a guess as to whether or not they were going to achieve it, and how high or low it was going to be above or below that guidance, just because the circumstances were so unprecedented. So if we're in that environment, or otherwise just in an environment where we don't provide earnings guidance for whatever reason, and a lot of companies choose not to, then what does the market expect if we haven't told them what to expect? Well, in many cases, there are analysts, brokers who publish reports on companies for their clients, and they provide often an earnings range or other guidance for their clients. And so in the absence of the company itself providing guidance, you would often then look to what are the analysts that are covering that stock saying, and that will be considered the expectation of the market. And then finally, if there aren't analysts covering or enough analysts covering to get a good spread, then you just look back to the prior corresponding periods. If we're talking about full year results for FY 21, then you just look back to what did we achieve in FY 20, and is the difference 5 to 10 or more % off that. So that is generally what the market expects, or what ASX suggests you use as a guide for what the market would expect. But of course, again, it's just a guide. And maybe I'll just very briefly jump forward to the Myer case, and then we'll come back, because it goes to the point around what you've actually published. So apologies, I'm going to ruin the information to come while I just quickly skip it. I think this is an important case because it really goes to the question of what does the market expect. So in the Myer circumstances, what happened was the CEO made some comments to the media around anticipated sales and anticipated net profit, and essentially said that he expected that it would grow and grow from the prior corresponding period. So the market therefore expected, it was found that the market therefore expected that NPAT would need to be above 98 million because that's what they'd achieved in the prior corresponding period. When they released their half-year results, so that's periodic disclosure, to draw that distinction as Scott mentioned earlier, they then provided some guidance around what the full year expectation was. And at that point, they said, well, our expectation for the full year, based on what we've done in the half year, is now we expect NPAT to be set between 75 and 80 million. And understandably, upon receipt of that information by the market, the share price fell by more than 10%. So the reason why it fell, you can read into it, is because the market until that point was expecting 98 million, because that's what the CEO had said to the media. And then they said, well, actually, it's not going to be 98. It's now going to be between 75 and 80, we expect. So, I mean, we could do an analysis like we started to talk about before about when did they know and all that, and should they have waited until the half year. But really, the important point around this case is around de facto guidance. So although it wasn't formal published guidance that Myer had provided back in September, because of the statements that had been made by the CEO, the court found that it was reasonable for the market to treat that as some form of de facto guidance, and therefore that was what the market expected. And so any deviation of a material nature, so between 5 and 10%, off that expectation of 98 million, would therefore be considered material. So I think that's just an important point as I just jump back.
And that can be a really hard one. I think one of the hardest things in this whole continuous disclosure compliance piece is trying to get a read on what the market expects. Because to some extent you say, well, I don't know. The market is not any one individual. It's kind of thousands of individual traders and trading firms and brokers and analysts. How are we ever supposed to know what exactly they expect, or that the information we're now in possession of, whether it will be a surprise to them, positive, negative, or they'll be indifferent. And so these are the guides, but the challenge, I think obviously with the Myer type example where the CEO has gone out and made a comment, but of course that would have just been one of hundreds of comments made during that period, has gone out and made that comment. It's easy to see why the market was expecting that particular level of earnings. You take the Nuix example right from the start. In their half-year results, they said they're on track to meet the prospectus forecast. Prospectus forecast was only put out 4 months earlier. Just on that information alone, you'd look at it and you'd say, well, that sounds like that's a reasonable expectation for what the market would be expecting, i.e. that the performance forecast is met. If the market has got ahead of itself, is that really Nuix's fault? And the way the continuous disclosure rules work is essentially it is that you need to assess what the market is viewing your stock at. And if you've put out guidance and the market now thinks that you're going to significantly exceed guidance, then that's your new benchmark. And that can be tough. And as I say, I reckon it's one of the hardest things in this because there's so much subjectivity to it. Sorry, Jeremy. I think it's on to David Jones. We're really piling on our department stores here at the moment, but this one's just too good to not mention. And for those of you who were around in 2012 in Australia, you'll no doubt remember it because it was all the talk of the town. So David Jones got an unsolicited takeover approach from an outfit called EB Private Equity. They were told, and we know this all after the fact, but it wasn't public at the time, they were told that it was about to be leaked on a blog out of Newcastle in Northern England, and which is where EB Private Equity was from. again, after the fact, a bit of due diligence uncovered that their registered office was between a wig shop and a noodle place in kind of the back streets of Newcastle. They put in an offer for David Jones at $1.6 billion, obviously highly conditional, indicative, like these offers always are, even from credible parties. That's how they're framed. There's no kind of binding commitment. It's not something that's able to be accepted. So it can be walked away from very easily. Faced with this offer and a threat that the information was about to leak, David Jones formed the view that it was required to be announced. And so they put up the announcement that you've got on the screen there on the left to ASX, which essentially says we've received an offer. They don't say the price. They say there's no usual public information about the bidder. So they're calling into question the credibility of the bid. And they recommend that shareholders treat the information cautiously. Shareholders did not treat the information cautiously. That's not really how the market acts. So if you just jump to the next slide, Jeremy, we've got the price reaction, which is that the stock jumped. It's on 29 June there. Stock jumped just under 15% that day on pretty heavy volume, kind of over $50 million worth of shares traded at a significant premium to where it had been at. Again, with the benefit of more digging, became apparent that their website, and this is the sort of stuff you would have thought you could pick up very quickly. So EB Private Equity had a website. It was designed by a local 20-year-old within Newcastle who had done very few other websites. There were no contact details on the website, no phone number. They'd not spoken to anyone from EB Private Equity. No one that they spoke to knew anything about EB Private Equity. Extensive kind of media investigation could uncover almost nothing about EB Private Equity other than that they said on their website they'd done a number of large real estate deals and distributed liquor globally, none of which could be substantiated. The market obviously up 15% during the course of the day. You can imagine people down at David Jones were not feeling particularly happy with themselves. There was more inquiry. The next day they go into trading halt and then put out an announcement where they say who the bidder was, say that it was EB Private Equity. The stock crashes as everyone realizes that this is a sham bid, or at least a bid that seems extremely unlikely to be genuine. And in the wash-up, there were no regulatory or other consequences for David Jones. There was a fair degree of loss of face, but there was a lot of reflection among others in the market as to what would we have done? Would we have done anything differently? And I think, I mean, personally, a fair bit of sympathy for David Jones, because the nature of continuous disclosure is you're being forced to act very quickly, and you've got to make decisions on the fly. And generally, the safe approach is to announce. Is if in doubt, as long as it's not going to harm you, announce the information, because the ASX will normally take the view that if you're unsure, you should disclose. And I think the failing here is not so much that they disclosed, it's probably what they disclosed, or that they didn't disclose enough. And I have to wonder if they had announced in their first announcement on 29 June who the bid was from, that it was from EB Private Equity, and perhaps even said that they've not been able to speak to anyone on the phone from EB Private Equity and they've only received correspondence by email, I'm not sure the market would have jumped as much. I'm sure there would have been a few trigger-happy traders who put in some early bids, but the market would have been in possession of sufficient information to form its own view on credibility. Whereas with the announcement that they were given, it was very difficult for them to assess that view as to credibility, whether it was a genuine PE fund that just didn't have committed funding, or it was a noodle shop putting in a $1.6 billion bid for a company on the other side of the world. So there's definitely lessons to be learned, but at the same time, I have a fair bit of sympathy for David Jones and the position they found themselves in.
And I suppose the other question is, what other options did David Jones have in those circumstances? And so really, if you look across the spectrum, they could do nothing and then wait and see whether it leaks and have to respond to that, either respond to the market or respond to a query from ASX. They could announce, as they did, which we can now see in hindsight didn't work out particularly well for them in terms of the share price fluctuation and the loss of face. they could have provided a bit more of a substantive announcement at the time, or perhaps the last option, although there's a lot of strategic reasons why you may not want to do this, is they could have paused the trading in their shares while they gathered that information. So they could have utilised a trading halt. So potentially when they thought that this was about to leak, they could have gone into a trading halt, done the further digging that they needed to do over the next 2-3 days, and then provided a substantive announcement when they came out of the trading halt that either at that point in time rebalanced market expectations so that when it comes out of trading halt, it doesn't run, by at that point saying, we went into trading halt because we'd received this. We suspected that it wasn't a legitimate bid, and we're pretty confident that that's the case now because of X, Y, and Z information that we have or haven't been able to find. And you can hopefully temper the market expectations and therefore the response a bit there. But I mean, as Scott says, it's a very difficult situation for the company to decide what to do, and to decide that in real time while shares are trading. And while that information is very fluid and not known as clearly as it's known now, so a very challenging situation for them.
Which is why it's so nice viewing them in hindsight, because it's super easy. Whereas at the time, I mean, you can just imagine that they were no doubt trying to disseminate the information for kind of hours. Like with a group like David Jones, there's a lot of decision makers trying to circle it around, draft up an announcement, get it to the group, kind of get directors across it, management across it, and then trying to form a view as to what and when to disclose at the same time. And as I say, it's common to err on the side of just getting something out so at least the market knows what's happening, rather than it appearing on a blog somewhere and a leak having occurred, you having known that information before it leaked and not disclosed it.
Yeah, and on that, I mean, Jeremy, maybe it's worth flicking to the next slide, but yeah, I think there are a whole bunch of exceptions that a company can rely on, which requires, which allows a company not to disclose. I think in the David Jones scenario, I think the real tension would have been the threat that was made that it will be released on a blog, and so the optics of being seen to be behind the message rather than being in front of the story. Because I think they're, based on what limited information they had at that time, there were real, real reasons to justify not having to make a disclosure. So, and I think to Scott's point, once they decided to make the disclosure, perhaps what the mistake was, the lack of extra information to give context to the bid. So just talking through those exceptions, there are recognised circumstances where where ASX recognises that there may be material information, but notwithstanding that, it doesn't need to be released to the market. And that's fundamentally where a reasonable person would not expect it to be disclosed at that point in time. The information is confidential. And in addition to that, one of a number of limbs are satisfied, which we've sort of set out on the screen. The key one that we would deal with in an M&A context or transactions context would be that the information is still insufficiently complete. Which again, going back to the EB equities scenario, it's clear that David Jones had only received an incomplete proposal. So, at that point in time, I think there is a good argument that they would have been able to rely on the exception. Having said that, if the blog had included a leak by EB equity, then the confidentiality limb will no longer have been able to be satisfied. And so David Jones will have been put in a situation where it would need to have made an announcement at that point in time. So hence coming back to the question that they would have been asking at the time, is it better that we're on the front foot rather than waiting to be seen to be reactionary?
I think it's worth just touching on this for a moment, because the confidentiality point is typically the one that gives clients the most cause for pause and concern. And I think the reason for that is because it's often the one that's not within your control. So generally, if we're talking in an M&A context, you can manage the process around an incomplete proposal or negotiation and control when that ceases. Similarly, if you're preparing internal accounts for management, you can control that. But what you can't control is a leak, usually. And so that's a real challenge, because you'll often have situations where there's something that is absolutely material and we're not yet ready to disclose, but we're forced into a situation where confidentiality is lost. And as soon as confidentiality is lost, the market will start expecting things, and the market will start forming its own view around certainty of a potential matter occurring, whether that be positive or negative. And that's why you're stuck in a situation as the public company where you need to do something, you need to act at that point in time, because otherwise the market is just going to react on its own without the information being provided by you, which is a very dangerous situation. So what can you do in those situations? Obviously, you can disclose, but there are some other tools that are available. And we briefly mentioned it just in the context of the David Jones matter before, but really within a company's control, it can decide to seek a halt in trading of its securities for a short period of time, typically no more than 2 business days or 2 trading days. And you just do that very simply by sending a letter to ASX saying, we need to go into a trading halt. We need to go into a trading halt for this period of time. This is the reason why we need to go into the trading halt. So we're considering a potential acquisition, but we're not ready to announce it yet. Or there's been market speculation around a particular matter, and we need to be in a position to announce something about it, or whatever it is. We're awaiting judgment in a particular matter, and that's due later today. And so whilst that's being handed out, that judgment, we don't want the market to be traded. So there are a range of reasons why you might go into a trading halt. You then prepare an announcement, and then you come out of the trading halt once you've provided that update to the market, so that the market is operating again in an efficient manner with the information available. If you need longer, so you thought that you could get away with the 2 days and then you'd be in a position to announce, but you're just not ready to announce after that, then you can request that the trading in your shares be halted for a further period of time, but usually you'll need to go into suspension to do that. And the key distinction between a trading halt and a trading suspension is the implications that going into suspension have for your ability to carry out other corporate activities, particularly in a capital markets context later. So the obvious one is your ability to issue a cleansing statement where you issue securities. So issuing shares to the market, allotting them without the need for a prospectus or another disclosure document, your ability to do that is dependent on a number of factors, but one of the key ones is not having been suspended for more than 5 days in the previous 12-month period. So you do need to be conscious that when you go into suspension, there are other implications. But it is a tool that's available to you. And then there are tools that are, of course, available to ASX as the market regulator as well. They might decide that for whatever reason, they don't think you should be trading, your shares should be trading because the market's not informed, and they may put you into a trading halt or into a suspension, and then request from you that you provide an update to the market, and they'll only remove you from suspension when they are satisfied that the information in the market is now complete enough for the market to be able to trade on an informed basis. And so you do see that from time to time as well, where ASX will place you into suspension, and then you may end up in suspension for quite a significant period of time until ASX is satisfied with the answers that have been provided. And obviously at the most extreme end of this slide is removal. So obviously ASX can choose to remove you from the official list if they're not satisfied that you can continue to keep the market appropriately informed, and therefore it's not in the interests of the market from an efficiency perspective for you to remain a listed entity.
Maybe I'll just talk to this one, which is one of the changes that was introduced by the government, notionally in response to COVID, but also partially in response to a review of the class action and litigation funding market. And the nature of the change was really to designed to reduce the exposure of directors and companies to unreasonable class actions by providing a layer of protection in the form of the fault element to continuous disclosure. So if you recall back to the discussion at the start where we were reviewing what the continuous disclosure test is, and it's around becoming aware. So once you're aware of information, and then if that information is objectively information that a reasonable person would consider would have a material effect on price, then you need to disclose it. What this change does is you're only going to be liable, and keep in mind this is only civil liability, so there's no change from an ASIC criminal prosecution perspective. But from a civil liability perspective, you're only going to have liability if you knew, were reckless, or were negligent as to whether that information would be materially price sensitive. So it provides a layer of defense. I think, and we've discussed this quite a lot as kind of a firm and a group of corporate partners together with the litigation partners. And I think the consensus around our table is that it makes no difference at the front end. When you are deciding whether or not you should disclose something, the old test should still apply. You should still, if you think you needed to disclose it before, you would still need to disclose it today. The place that potentially makes a difference is at the back end. If you're a litigator or a class action firm trying to take someone on over what you consider to be a failure to comply with continuous disclosure obligations, it is going to make a difference. How much of a difference, I guess, remains to be seen, but a difference in your the prospects of you being successful in bringing a claim against a board or a management team for failing to disclose. One caveat to that I say today, because that's actually not right. The temporary exemption under the COVID relief regime expired on Sunday. The government is currently in the process of making this change permanent, but it's at second reading in Parliament with no certainty as to if and when that will become law. The hope is that it will come in sometime in April, but at the moment, we are effectively under the old regime for a period between the expiry of the temporary relief and the permanent amendment coming into place. So I think the takeaway is business as usual. Hopefully it'll help you if you ever find yourself in the gun from a class action firm, but otherwise continue as you were.
Yeah, I mean, I think it's a little confused in the sense that there's no equivalent changes to the underlying listing rules themselves as well. So still the listing rule regime that applies as you understand it. And I agree, Scott, it's really just a back end issue rather than changing your view on how you would assess continuous disclosure in sort of live time.
We have a few minutes left. If anyone's got any questions and they want to post those through on the system using the Q&A function, we'd be happy to answer those. And otherwise, we've got a few case studies that we can talk to. So we spoke to the Maya one already around.
We've got one question here, Jeremy. It's just come in from someone in relation to investor briefings and how they fit in and why people get into so much trouble with investor briefings. And it's something we haven't really talked about directly, which is not so much a failure of continuous disclosure, but it's really a case of not going far enough. So the problem people tend to get into with investor briefings is where they have put out their results. They'll then go to an analyst meeting and they get asked questions which solicit information which goes beyond what was in their ASX disclosures. So the fault here is in what's termed selective disclosure. So the company is selectively disclosing to a limited subset of the market, i.e. those in attendance at the investor briefing, information which is materially price sensitive, which has not been disclosed to the market as a whole. So it's one to be very cautious of. I think the key is to carefully review a transcript or even better, the proposed kind of disclosure and effectively a script for what's going to be said in those analyst briefings. And analysts have a pretty good understanding of the law, in my experience. They tend not to want to be made insiders, which is one potential outcome where they're provided with price sensitive information that the market doesn't know. And are generally pretty understanding of look, I can't say more than what is in the ASX announcement, or a response that really just refers them back to the ASX announcement. And then ultimately, if under pressure you think it's appropriate to disclose more, the appropriate response would be to tell them that you're considering it and you'll assess whether further announcements required. And then if that's in fact what you think is needed, then you put out an announcement to the ASX rather than respond on the fly to an analyst and potentially effectively leak information to a subset and result in an uninformed market.
Thanks for that. We should probably just work through one other case study, because I think it's quite interesting, and it's around positive news or information that you put into the market which results in the share price going up. Because a lot of what we've spoken about to date has been around, managing earnings surprises, and often, not always, but often those earnings surprises are missing expectations or some sort of reduction, and the market having expected it to be worse and then getting punished by the market when ultimately you release the result, a bit like the Nuix example right at the beginning of today's session. But companies will also look to make positive announcements, of course, and you need to be careful when you're doing so what you are saying and making sure that information is accurate and that it's not misleading or deceptive in the way in which it sets expectations within the market. So the recent situation around GetSwift is a good one there, because what happened there, and you can see the background on the screen, they announced that they'd entered into a range of commercial agreements for their business. They clearly knew that we'd assume that they clearly knew that the share price was going to increase as a result of those announcements, because they were positive news for the business. And they did significantly, 1,900%, which is a pretty big jump. It turned out later that those agreements that had been entered into really weren't true agreements whereby there'd be, an ongoing revenue stream. In fact, they were really just entering into some very limited trials with these customers to see whether GetSwift's offering was going to be appropriate for them. And when it came out that that's actually what those agreements were or weren't, the share price of GetSwift got impacted significantly on the downside. And although this is still playing out in the hindsight space, I think it's very important that you as either directors, management, or practitioners in-house at companies that are going to be faced with these decisions, and often faced with a dilemma whereby the commercial team is pushing for positive news to be put out into the market, knowing that it's going to increase the share price, it's going to create positivity and expectation in the market. You do need to be conscious of what it is that you are disclosing, and understand that whilst in the David Jones example, not enough information could be dangerous, but also too much information or not the right information can also be dangerous. And you need to be really careful and precise around the way in which you disclose information to the market, and of course, just making sure that information is correct, that it's accurate, and that you're not implying something by the way in which you make an announcement that isn't truly there, but is done so just designed to improve the share price.
Yeah, that's interesting, isn't it, Jeremy? Because we've spent most of the day talking about kind of whether to disclose or not to disclose, and I appreciate that was our Shakespearean title. But if you do a bit of a stock take of the class actions, the kind of the litigation in relation to continuous disclosure, it's roughly 50-50 between failure to disclose at all and having disclosed but done so in a manner which is misleading and or deceptive. And so the first part's what we were talking about, kind of did you not disclose when you should have? But the other one is like GetSwift, you do disclose, but you've disclosed the wrong thing, or you've disclosed in a manner which misleads the market. And so not really a topic for today, but certainly something to keep in mind is once you cross that Rubicon and decide, yes, we will disclose, you need to be very careful about exactly what you are disclosing.
Well, on that, I think we'll end today's webinar. So thank you very much for your attendance today. Appreciate your time. And hopefully it's been an informative session for you. It's obviously an area that is not clear cut and is always moving, and there's always a number of cases that are out there changing the way we think about it and ways in which we apply the guidance. But hopefully you've got some takeaways from today in terms of the way in which you ought to approach these problems in your everyday working life. In terms of determining, when is it that the entity is becoming aware, what it is that information, is that information material, what are we comparing it against from an expectation perspective, what sort of impact is it likely to have, do any of the exceptions apply, and then if we are going to announce, what are we going to announce and how are we going to go about doing that? So thank you very much for your attendance. We appreciate it, and we look forward to presenting to you again in the not too distant future.